Good afternoon, I'm Guneet. Sorry, I'm not Guneet, I'm Antrika. I work at a family office called Greentree Family Office. It was set up by the promoters of, the erstwhile promoters of a group called Camlin Group, which is famous for stationery and a specialty chemical business. And our founders have a strong resonance to climate impact, which is why they set up the family office to exclusively invest in climate impact businesses. And thus far, like, we've been in operation for 5 years, and we've invested in sustainable mobility, green chemicals, and energy efficiency. But I'll explain to you how we look at climate impact investments, and we feel we look at it slightly differently. Uh, for us to invest in a company, there has to be an economic engine which is self-sustaining. And by economic engine, we mean that the return on incremental capital needs to be very high. If that is high, even if you invest a little bit of money, the business can self-fund itself for a long period of time and compound itself. And if a business is able to do that in a way which creates climate impact, in that case, it will crowd out incumbents who may be operating in a slightly dirtier way. And slowly, the, the influence of impact will grow in whatever ecosystems they're operating in. So, for us to even get interested in a business, it is very important that the economic engine exists, and to see that, the businesses need to be in growth stage, as Ramraj mentioned. So we invest in growth stage businesses, in climate impact businesses. For now, we invest in India, but we believe that climate is a global problem, and solutions which address climate are technological solutions at its core, and technology is applicable everywhere. So we look at global opportunities as well. But yeah, thanks for letting me share our perspective.
Thank you, Atraya, for sharing your perspective as Reentry's family office and the journey that have been with the impact investing space. Now, as we move on to our next segment, which is a panel discussion aimed at unveiling India's impact investing landscape, we'll hear from our sector specialists who have been actively investing in this space and have witnessed its evolution over the years. Allow me to introduce you to our esteemed panelists as well. We have Jinesh Shah, Managing Partner, Omnivore for Agriculture, Smita Sarkar, President and CEO, Grey Matters Capital for Education, Himanshu Sikar, Project Director at Samrit, a healthcare blended finance facility at IPE Global Limited. He'll be speaking about health. And we have Harsh Shah, investment professional, Oiko Credit, who will be speaking about financial inclusion. And Sarvesh Kanodia, Director at Omedia Network India, speaking about technology for development. Last but certainly not the least, we have our esteemed moderator, Mr. Nakul Zaveri, co-head of climate investment strategy at Leapfrog Investments, who will also provide insights on the climate space too. Over to you, Nakul.
Thank you. Hello. Thank you very much. I think what we can do is, if we can do, we'll go sequentially, but I think it is important because we have so many sectors to really talk about what impact criteria are you thinking about, right? Because at the end of the day, we are thinking about impact investing here. So it will be good to go a little more deep in terms of your background, why you are doing this as an institution, also probably why you are doing this as an individual. This is an emerging asset class. It is such a broad definition when it comes to impact. There are some nuances that people kind of misunderstand. This is not, I think the people who are sitting here is a combination of philanthropic capital, patient capital, commercial capital, and everything else in between. So I think it is important for the audience to get a better understanding about where each one of us are coming from, and things that we get excited about, right? I'm going to start with myself. So my name is Nakul Zaveri. I am a partner at a global lead sectors, which is financial services, healthcare, and climate solutions. Our focus is towards the emerging markets and specifically towards the emerging consumer. Our thesis is built around the emerging consumer, who's defined as someone earning between $2 to $11 a day. We believe that emerging consumer essentially is will start moving into prosperity in some sense, and therefore we'll start creating a different market for these goods and services. We are not a concessional return investor. We look at superior risk-adjusted returns, and we believe that in what we call the global growth markets, this is acceptable, deliverable, and we have delivered this at scale. We manage close to about $3 billion now across Africa, South Asia, and Southeast Asia. We do both level investments, so we invest between $30 to $50 million. But for us, what is important is at a platform level, the number of emerging consumers we reach. And that reach is defined in a very, very clear manner. There's a methodology around it. It is audited, it is verified. And that reach number now, with climate coming in, we overlay that with the emission reductions that take place across emerging markets. And we can, I'll leave it at that, but we can start with Smita.
Yeah, hi, I'm Smita Sarkar. I look at the global portfolio of Grey Matters Capital as its CEO and president. Grey Matters Capital, for those who don't know, has been in the impact investing space for more than 2 decades. And initially it was called microfinance. And then in 2006-07, the impact investing phrase came up. And Nakul said to kind of describe our philosophy so that you can actually differentiate who all are sitting across on this table. So if I go back and actually look at its proprietary money, it's a US 501c3, which does impact investing, which means it does equity, debt, outcome-based financing. And if I look over the 2 decades of journey, what I notice is that we've been like a bridge capital. So in microfinance, we were a bridge capital before a lot of grant funding had already come in the 1970s to bridge it to commercial capital, right? So a lot of value creation was there, and then we invested in a lot of financial inclusion. Some of the portfolio companies we still hold, so that speaks to the number of years you have to hold something. Then we went on to actually create the first education finance company in India, which we then replicated very recently in 2018, 2019 in Nigeria and Pakistan. And what it again did, and I'm appealing to the catalytic nature of the kind of work which family offices can do, is that it actually created a lot of other companies which came after Indian school finance company like Vardhana, and now you have bigger banks coming in and populating the space. So there is value creation and value capture. Coming more to the recent side of things, other than some of the investments which we are holding in banks and all, we also invest in funds and do direct investments and debt. And over there, the space which we are in is actually human capital, the human potential, right? And now I'm just going to come into India as a country. Over there, the portfolio which we have in the products, impact is very, very essential, especially with the NEP, the National Education Policy, helping some of the portfolio companies now to really do the impact work and scale. So we have across life stages, all from pre-K, all the way to skilling and earning. And how we measure impact is actually to simplify it, right? We can have vanity numbers, but like Nakul said, the methodology and all. And we looked at it and actually said, okay, what is the delta change in the amount of money in the hands of the last mile consumer or beneficiary, and that for us is also linked with the gender targets which we have. So delta change in economic gains for women. What I'm personally excited about is the catalytic space that a GMC or firms like this actually offer us to look beyond the 1 or 2 years, but over decades as to what our contribution and purpose is.
Thank you, Nakul, for setting the stage, Smita, and everyone here. I'm Sarvesh Kanodia, part of the investments team at Comedia Network India. I've been with the fund for over 8 years now. And to partly answer Nakul's question, actually, prior to joining Comedia Network India, I worked across a couple of other private equity funds and joined Comedia Network India, where I didn't know actually much about what impact was. For me at that stage, very earlier in my career, was almost an experiment. Let me try out and see whether it works or not, and till date have continued to stay, so which means that I do end up believing in what we do. As a fund, we've been operating in India for over 13 years now. The fund was started by Pierre Omidyar, who is the founder of eBay, and really the founding philosophy behind starting Omidyar Network India was how could he use all the capital that he had created through eBay to put to use to create large-scale social impact. And there were a few fundamental choices I think that we've made along the way. One was the use of technology. I think just given his own personal experience for how eBay shaped the lives of many, both the buyers and the sellers who were on the platform, it was very clear to us that whatever we do, the undercutting would be the use of technology, because that is one element that allows it to scale. And so in order to reach the target segment, we have to use technology. That's been the sort of core of all the work that we've done in India thus far, and globally as well. We use a dual checkbook model where we make both for-profit investments, like other VC investors, but at the core of it is also impact. So we look at both financial returns, which are market-adjusted returns, like other investors would expect, but are also equally stringent on our impact criteria. And we look at investments that can deliver both. This is where roughly about 75 to 80% of our capital has been deployed, and the remaining 20-25% has been on the not-for-profit side, which is basically grant capital. And there, the ultimate aim is impact. We are not expecting that capital to be sort of returned back. On the venture investing side, we are early stage investors, so seed series A, typically the first check in most of the companies that we invest in, where most of these times the ideas are early, they haven't been proven. And the idea is that can we provide that catalytic capital, for those companies so that they can prove out what they are trying to do. In terms of impact and the way we measure it, we've called out our target segment as the next $500 million, which is basically the 500 million Indians who've come online over the last 5 years. And the idea is how can we use technology now that they are using technology actively, how can we use that to serve them better. We invest across a range of sectors as a result, because what we do see is that their needs are varied, the life is complex. So in order to serve them well, we do have to look at multiple sectors. So right from education, healthcare, agriculture, financial services, mobility, we invest across a range of sectors. One of the reasons this has also sort of benefited us is that each of these sectors also go through a cycle. So by being sector agnostic, it also as a fund level doesn't expose us to cycles that any one particular sector that might have at any particular point in time. But what we do is that within the fund there are sector specialists. So I end up focusing a lot of my time on education and employability and agri. I've looked at some other sectors in the past as well, and similarly the other investment professionals end up focusing on different sectors. What it means for us is each of us can then go deep in that particular sector, build our sort of specialty, and it helps us source the best deals in the market as well. So that's a conscious choice that we've made. One of the things we've seen in over the 13 years of investing in India is that we're actually seeing impact as a differentiator for us, and that's the positioning that we've created. And this has been a point of constant debate that because you're an impact investor, do you end up getting perceived differently, etc., etc. But given all the work that we've done, we actually now very proud of the fact that when we pitch to our entrepreneurs that we are impact investors, And the reason I think this is also helping us now, because we are seeing entrepreneurs who are not just building a company for money, but they are also equally invested in the fact that they want to make the world a better place, in whatever work they are doing. So from that perspective, it also helps us get access to those entrepreneurs who like the fact that when we are on the board, we are not just talking about financial metrics, but we are also, holding them accountable on impact metrics. And that is something that we've, seen as, feedback constantly from the entrepreneurs that we work with. Finally, I would say just on the impact investing industry, when we started, venture investing in India was very early, and impact, investing even more so. But what we've seen in our portfolio actually is that high impact is equal to high returns. The companies what we classify as, highly impactful are also the ones that have created most amount of returns for us. Till date we've returned more than $250 million, which from an early stage, fund perspective would perhaps be amongst the highest in the country, and certainly so from a impact investing perspective. And which is why even, so we have a single LP, and our capital, in that sense we've deployed almost $500 million over the last 13 years, and the target is to now deploy a similar amount over the next 4 to 5 years. So our belief definitely in the impact investing space has, strengthened given everything that we've seen, and the idea is to not only double down, going forward.
Thank you. I'm Harsh Shah from EcoCredit, and thank you IIC for the opportunity to speak on financial inclusion. So I've been in the impact investment space now for about 10 years. Ever since I started my career, in fact I started at a microfinance company, then joined Aspen Impact Investment. Was with a startup called Stellar Technologies in the agri-tech space for about a couple of years, and for last couple of years been with EcoCredit. EcoCredit is a Netherlands-based organization, impact investor, and been there for 45 plus years. Certainly, older than me, and even older than the term impact investment itself. So we've been investing in financial inclusion space, agri-tech, and clean energy space across 33 countries. We have over €1 billion of AUM. The way we define impact is, we have a community-focused approach. What Nakul mentioned actually, in terms of focusing on a low-income group community. We focus on people who earn between $2 to $5 or $2 to $10 per day basis, and that includes financial inclusion space as a whole. And we believe that credit, because people lack credit, having an access to credit basically makes them sort of take their lives in their own hands and empower them in a sense. So we started from microfinance, moved on to MSME finance, affordable housing finance. We have a few fintechs in the portfolio as well. And then few other segments that we've been looking at. It's an extension of financial inclusion as well. So it's been a very enriching experience for us overall. We have over $1 billion of AUM spread across 33 countries. So it's a similar journey that we see across other geographies as well. And India, of course, provides the maximum impact as well as maximum exit opportunities as well. So India remains the largest market for us across the globe.
Sorry, before we jump here, I want to reiterate on two things. There are a lot of words being thrown around, right? So catalytic, impact, convergence. I think you may want to keep that in mind and ask questions as we move into a Q&A session. It'll be interesting for you also to kind of address some of those basic questions. Specifically, why impact? Right, that is important. I think it's a starting point. Second thing is, remember this impact investing. So there is investing is the second part of things, right? So we are also looking at creating returns. Why it may be different for different type of investors. And I think Sarvesh, you are a little different than most of us here because you're single equity. And as Dinesh would appreciate, fundraising is a humbling experience. And like family offices, you guys have the power to make quick decisions, have an ethos towards investing in what you guys believe in, right? So it's important to see how to strategize this, right? And why you are doing this more than, there are some of these noises around whether it is climate or whether it is impact or whether it is low income, but it's important to understand the crux, what are we looking for? Sorry, Ramraj, before that, anything else?
Yeah, no, I was just trying to respond to what you said on single LP. I just met yesterday, whose principals have been, he also has single LP, and his principals have been telling him to diversify away from single LP, primarily, so that you have many more people and power is distributed rather than one person sitting on your head and telling you on a daily basis what you should or should not do. But I think what you have here is a very diverse bunch of people, someone with a single LP, someone who's doing very catalytic stuff, and I don't think we touched enough about the business model of Oiko and the liability structure, which is, it's a very unique structure through which funding is raised. It's almost like a cooperative kind of a structure, and the funding is obviously being used globally. But I think we should hear from Dinesh and Himanshu on some of the ways in which all of this is deployed. But I think it will be useful at some point to also talk about some of these things, like the catalytic part that say GMC does, or some of the other models. So maybe, I think, should we hand over to Dinesh, or?
No, I think let's finish this.
Thanks, yeah. Thanks, Ramraj. Thanks, Nakul. Look, my name is Dinesh. I run a food and agri fund. Right? We started as making investment in agriculture sector. We didn't understand the word impact. Right? For us, it was a business model. Saying, if I put money, will I be able to make a business model which can scale, and I can get an exit. Right? That was a simple thought process. In the process, we learned the word impact. We understood, okay, this is catalytic capital, and it's a new way of saying that while you're making investments, you can also do good, right? For us, it just fits within the criteria, because from the day one that we invested, we're looking at the theory of change, saying that what did I and Mark come together to do it, right? So we had 3 or 4 aims in our life, saying that in our lifetime we can solve 2 or 3 large problems of agriculture sector. The smallholder farmers, starting with India and hopefully doing other parts of the world at some point, starting with equity and doing some other asset class at some point, we said let's focus on audit. So first was saying, can I make farmers more money, right? We don't talk of increasing yield, we don't talk of reducing the cost, but say, can I make more profits? That's for the farmers. Second, can I make agriculture sector more sustainable, right? We have seen some years where farmers make a lot of money, some years they have a bad time, and because of this ups and downs, they are unable to plan their life, right? So we said, can we make it more sustainable? Can we bring the resilience in terms of, can we reduce the uncertainties? There are issues about monsoons failing. I mean, every urban Indian has a different view about how Indian farmers should be doing it. I mean, the moment they will pay some 20 rupees extra for a tomato, everyone starts abusing the small farmer, right? I mean, so that's the third. And fourth is we said, let's do something which is pro-climate, right? I mean, for agriculture sector, climate was done, investment was done, climate investment, way before the climate definition was being arrived, right? I mean, we used to make seeds, new fertilizers, new kind of waste, reduce the usage of water, irrigation, and the climate investment is not even defined, right? So that's what we did. Over a period of time, we realized that we are an impact investor because we can raise a larger pool of capital, because for me, agriculture investments, very few investors are willing to put money, right? The moment it becomes impact investments, the pool of capital available increases. And for me, that is important because I'm in the business of fund investments, making scale and getting an exit. I mean, we never have any issues about reducing we never talk about lower profits or higher profits, because it's an investment, right? Investment has to be profitable. That's what we define. So for us, a term theory of change was important, and that is what we defined. We also realized that we cannot be focused or being just on the Indian markets, right? Smallholder farmers' problem across the world is similar. So we realized that can we start learning from India and going across it, or vice versa, what can be done? And third is we always push investors who are investing with us, saying that please think that you are making an investment in this sector, so you need to have a different thought process, right? You cannot be thinking like a tech investor or education investor or something, because in agriculture you have 2 or 3 times of farmers can make money. And we're going to make money on the basis of they make money. So if you're going to look at exit in 3 years, 4 years, we are not the right investors. We always start saying that if you are a long-term investor, you want to look at scale, you want to make an impact on the basic income levels of a large population across the globe. I think we are the people. And that's how we defined around it. So, I mean, that was the opening comment. We were not calculating, we were not impact, we just were normal investors. We learned the way of,
Honest.
I mean, to make money, right? That's how we got that. Thank you very much.
Thanks, Dinesh. I am from IT Global and I lead the Samrit Blended Finance Facility, which is housed at IP Global, an initiative that we started 3 years back with support from the USA, Rockefeller Foundation and others. And unlike the other co-panelists, we are not a fund, we don't do investments directly, but we are more of a facilitator, a platform which brings stakeholders together who are interested in seeing last mile impact in the healthcare space together. And when I say stakeholders, it ranges from commercial investors, equity funds, to banks, to government, to academia incubators, and so the entire kind of, and above all, the social enterprises and the healthcare enterprises that operate in the country. The facility itself was set up with impact, going to the last mile, and the challenge that the pandemic was throwing to us with a kind of another view. It was established just weeks before the first lockdowns happened in the country, and the idea was that with the lockdowns happening and with the health sector coming under a lot of pressure, there will be a need at two levels. One would be to address the short-term capital crunch that our existing healthcare infrastructure would face. Because at one point they would want to upscale their infrastructure, but then the regular flow of cash would be strong, and they would not be able to access capital as much as they would like to. Secondly, to address the pandemic again, there was a need to also look at our innovative social enterprises that were operating in the country, so that how we can help them scale up their operations quickly. So with that kind of a mandate, Government of India, USAID and IT Global came together to establish this facility. And what this facility does is it works at multiple levels. The starting point is how we can de-risk for the commercial investor their investments. Now this commercial investor can be a pure play entity who is just making investments for returns, but not touching a particular sector because they perceive that sector to be very risky for their investment. Or they could be impact investors who have last mile impact in mind. So how we de-risk this investment is we use the philanthropic capital coming from large donors like USAID, Rockefeller, to national CSR providers as well, using tools like risk guarantees, interest subvention, recoverable grants, returnable capital, zero coupon loans, etc., and enable the social enterprises working in the healthcare space achieve their scale-up ambitions. At the bottom, and to Nakul's earlier question, that what's the impact that one is looking at? So for us, or a facility like this, impact is it's core to us, and we look at it at two levels. The first level is at the outcome level, which is easy to measure, and there the parameters we look at is one, that affordable healthcare reaches the last mile, and when I say last mile, in our case, specific focus is on tier 2, tier 3 towns and rural areas, because if you look at the investment landscape in the healthcare space in the country, huge investments have come in, but they have been largely concentrated in the 9 metros, and nothing else kind of gone deeper than that. So that's where we kind of come and fill the gap, go to the tier 2, tier 3 towns and rural areas and help enterprises which have that as part of their vision and mission. Second thing that we look at is that how that quality healthcare reaching them is bringing down the out-of-pocket expenses for the people that we want to reach out. There are a few, like one is of course the direct reduction in the cost of treatment, and then the second part we focus on is that you have insurance providers, you have Government of India's own insurance program. So the enterprises that are focused on addressing PMJY beneficiaries, for instance, get a preference when we are making the investments. So that's at the outcome level, which is easy to measure. More at the impact level, the ultimate goal is that the quality of life of the people should improve, and secondly, how many lives are we able to save in the process, which otherwise, because of one reason or the other, would not have survived. So that's the kind of impact matrix that we look at. We do impact measurement in-house. We have third-party evaluators who help us do that, and we are very soon kind of finalizing our impact report for the work that we have done for the last 3 years, and we'll be coming up with that. But if you look at the last 3 years journey, it's been a very exciting journey. A lot of regulatory issues came in the way, but we were able to kind of navigate some of them. Some of the challenges still remain. But in the last 3 years, we have been able to kind of deploy around $17 million of philanthropic capital and leverage close to $250 million of commercial capital using that. And this commercial capital is coming from mainstream banks, like Axis Bank, HDFC, Caspian Debt have been kind of some of the key partners. Plus, we have been agnostic to other banks also. Anybody can come and make use of the facility. We have supported close to 60 enterprises who not only have a pan-India presence with their solutions, but are also now exploring global markets, going to East Africa, Southeast Asia, and other developing countries where the challenges are similar. The solutions have reached close to 43 million people in the geographies that we focus on. And by design, we have tried that most of the solutions are deployed in the northern states or the weaker kind of states in the country. That's been the journey, but yeah, as I mentioned earlier, the idea here is not to kind of create a new instrument or anything, but to change the behavior of the mainstream investors and make them more impact oriented. So that's been the kind of bottom line that we have been working towards and continue to work towards, and how we can ensure that more and more mainstream capital can go into impact segments.
Thank you. I think I'm just going to reiterate the definition of impact investing. I know this is an impact investing led conference, but just so that all of us are clear, right? And there are various definitions to it, but just so that we understand, impact investing is essentially investing in companies with a very clear intent to create a positive social or environmental impact alongside a financial return. That's how people see broadly impact investing, and there are nuances to it. But what is important to understand is, again, as Ramnath said, that some of these things become very critical, catalytic in nature. So you want to try and build something so that mainstream or commercial capital who do not have impact as a criteria can come in and then accelerate the outcomes at a much larger scale as well. I think impact in 5, 10, 15, 20 years, in a sense, will get normalized. There won't be something called impact investing. As ESG is getting normalized, right? I mean, there is some element of social license of doing business, you know. I mean, we don't talk about, while there is still child labor existing, we don't talk about it. It's very clear in terms of black and white what companies want to do in that sense. But in emerging countries, there are massive haves and have not made. And there are a lot of tailwinds now coming through in business models that are now creating a path to prosperity for low income and emerging consumers. And therefore some of these business models work really well. And therefore I want to again talk about what are you excited about from a sector perspective, right? Are there one or two sectors that you like investing in those, or even if you don't like some of those sectors and your experience going through. And again, I'm happy to do the same kind of comment.
What I just go back to the impact. So I'll go back to the impact investing definition because in our experience, we also have a proprietary capital like Omidyar, which was put in, which kind of gave us a lot of flexibility. And just to give you some examples from it, and then coming back to what I'm excited about, you could take moonshots with it, right? So, for example, Village Capital came out of Rematas Capital, and the idea was very simple: that what would happen if peers decided who to invest in, right? Indian School Finance Company came in because in the microfinance 23 funds that we had invested in, over there, whenever the self-help groups were there, women would say education is the ticket out of poverty, and when the founder actually came to Andhra Pradesh and saw this huge affordable private schools, which didn't have capital, he just kind of put two and two together, and investment in a bank, an NBFC was started, right? So I understand that the definition of what the definition of impact investing is, but maybe because there are family offices here, you should use the pool for also taking moonshots. So as I look at GMC's, different types of capital, like for example, you mentioned Caspian, right? Caspian came, we are still the largest minority over there. It came out of IFIF fund, and it's doing great work. So I just, take into consideration the moonshots and the timeline where you can be catalytic. On the excitement part, other than the equity, blended capital, debt work which we do, what is important is what Ramraj talked about was around simplification of some of these models. That's what we are excited about. We are looking at the DIPS model and seeing whether we can do simple contracting to simplify, because it's kind of trust-based philanthropy on one side. We are going to take the risk and give, we call it guaranteed economic monetization, and actually see whether if we take the risk capital through a simple contracting facility, one of the outcome donors pays us once we show them a verified digital outcome. So that could be game changing. So we are excited about it, high risk of failure, but we can do it because single LP, right? The second thing which we are interested, which is required for impact investing, is from our experience what we have seen is that once the companies grow to a particular level, like Sarvesh said, right, impact becomes the differentiator. But for a lot of companies in India, the VC part may or may not be there. And is there a way for us to monetize that impact and bring it into the financial statements? So verified impact as a revenue line into financial sectors. These are things which we think, as we work along with other partners, to blend that money in, because we are also moving from a single LP to getting other people's money in towards the outcomes which we want, I think would be catalytic.
So in terms of the sectors, like I mentioned, we are sector agnostic. What we keep doing is both revisiting the sectors that we are operating in. If there is a need for us to, let's say, stop investing in a sector or double down in a sector, or let's say add new sectors, and within those existing sectors, what should be our sort of sub strategy in that space. So from the perspective, if I look at where we are deploying most of our capital today, I would say probably 5-6 core areas. One is education, second is healthcare, third is agriculture, fourth is financial services, and fifth is mobility. And across each of those, if I were to just probably say, we don't have enough time to go into each of them, but if I were to say one theme across each of them that we are excited about. So if I let's say look at education, skilling is one area where we are doing a lot of work. Both where we've published research that we think is definitely been useful to us. But the idea behind publishing was that could be useful to others as well, and it opens up more opportunities for entrepreneurs who are operating in that space, and that's something that we do across spaces. So on the education side, it's become the skilling side. On the healthcare side, access to affordable healthcare, especially on the hospital care side, that is something we are quite excited about. On the mobility side, electrification of both the 2- and 3-wheeler space is something that we are looking at. On the fintech side, we funded many NBFCs in the past, and one of the things that we are sort of quite excited about now is the whole fintech infra. And again, there we've made some investments which have worked out well, and we want to sort of double down in the agri side, we've invested in many market linkage companies. And one of the things which we are keen to do now is look at opportunities that actually generate more livelihood for the farmer in their local community. So be it local processing or ways they could increase their realization from the produce, which right now they're not able to because there's no processing happening at the farm gate. So there are themes. I mentioned one theme across each of those spaces, but for each of the different sectors that we operate in, there's a detailed strategy that we have, and happy to sort of chat offline in case it's of interest to any of you out there.
Sorry, before you go, I've been told that we've got 5 minutes left, but we will extend it to 7 minutes. So we'll be quick. Before we break into Q&A.
Per person or
As a group.
I'll be concise then. So I think impact investment in India started off with investment in the microfinance space, and that's how it also started investing in India. It later on moved to MSME finance. It's again a huge underpenetrated market. Banks were not willing to lend to MSMEs. Then came the affordable housing finance companies, and this an area where we are still sort of very excited about. Only 10% of the affordable housing finance market has been captured, and massive 3.5 lakh crore kind of credit is expected over the next 5 to 7 years to go in this sub-segment. When we say affordable housing finance, it's where the housing is available for less than 35 lakh rupees, and this is primarily in the tier 2 areas, or even on the territories of the larger cities or rural areas, right? So that's an sector that we are excited about. We already have one investment with Omidyar there. Another sector that we are very excited about is agri-fintech. Banks have lent crores of money, but haven't been able to recover their farmers. There are 7.5 crore Kisan credit card given 20% NPS, but then embedding finance with the trade is something that we are very excited about, and we think that that's probably the solution that can help agriculture sector sort of not only recover money from the farmer but also improve the productivity of the farmer. So I'll take a pause here.
Look, I only one sector inside the sector, right? So we have a couple of issues, right? And what's exciting or what keeps us awake is that we currently assume there is a food security for a lot of people, and Indians we assume there is a food security. But if I look at this couple of events in the last few years, right? I mean, a couple of wars, COVID, the food supply chain across the world has gone for a toss, and the world is not food secure for sure, right? At the same time, we're going to have a climate change. I mean, you're going to see areas where temperature rises to 45, 50 degrees centigrade. I don't expect farmers to do their job in the afternoons, right? We're going to have some crops where we might lose out those crops completely, right? I mean, things like bananas we are assuming today are going to be normal. Maybe we could just completely see the species getting out completely. So that's something which keeps us awake at night. We think food security for the world is going to be important because that's going to be geopolitically a pain if we don't solve that. And world might see migration happening because of climate change. I mean, we are seeing migration happening because of wars or famines, but climate change could be a situation where people will move to less hot climate. So these are things impacting agri as a sector, and that's what keeps us awake. And I don't know whether it's exciting or not, but that's at least mentally tiring at this point.
Thanks, Dinesh. Very quickly, from the healthcare perspective, we kind of get excited with 3 areas broadly. The first one being around medtech and AI and the kind of innovations we are seeing coming up in the country, which are kind of very low cost, high quality innovations, both in the medtech and the AI space, which not only have the potential of addressing the challenges in country, but throughout the world. And what we feel is that investments going into that space can kind of, like pharma is, India is the world supplier for pharma products, India has the potential to become the same for medtech and AI solutions as well. On the second side, I think global health security related challenges that are there and innovations that are addressing those, whether it's around antimicrobial resistance or solutions around diagnostics which link into the surveillance part. I think for both this area, COVID pandemic has shown us that it's something which is a looming threat for the globe at any stage. COVID happened, next pandemic can happen as early as next year, nobody knows. So solutions or innovations that are working in this space is something that we are quite excited about. And third area which I think Jinesh also mentioned a bit about is this interface between health, climate and food systems, because these three areas are very closely related. And from food systems, besides the farmers, is also the nutrition that we all are getting from the agricultural produce that is coming. So from that interface, how climate is impacting food systems and how it's impacting our health, that's another area which we are focusing on when it comes to focusing our investments.
One of the sectors which relatively is the most exciting today is really early stage healthcare. Not because of I have any great insight into healthcare, but it is a sector which today receives the least amount of investment. The risk aversion is the highest. The amount of money going in is the lowest. The deal flow is as sporadic as it can get. If we do maybe 30, 35, 40 deals, maybe 30, 35 deals a month in social impact, maybe 4 or 5 deals come into early stage healthcare. And when I say early stage, I'm not talking of the large scale nephrology clinics. I'm not talking about bigger transactions which are more PE-like. They are beyond growth stage. This is a sector where I'm surprised for a country which is so technologically relatively advanced. We don't see, there is hardly any health tech fund in India also. So, and maybe it is not very VC friendly, but if there are family offices and you're really looking at a space where you have greater capacity to create impact, I would really think that early stage health tech, yes, survival rates may be lower, it may not be a very traditional VC model because also it is manufacturing based. So, you don't have those so-called hockey sticks, at least even on Excel you will not get the hockey stick. In the real world is a different story. So that is a sector where evaluations therefore will be in my view better. And I think that is a space which I would think family offices given, I'm not saying that risk appetite of family offices is high, but definitely family offices have a little bit more, they have the capacity, as she said, to take some moonshots and things like that. So because at IIC we do this monthly deal flow analysis. So I start with A for agriculture and so on and so forth. By the time I come to H, there is barely 2 or 3 deals which also we will struggle, because every deal we don't classify as health impact. Because somebody said, supporting a large scale dialysis clinics in top 10 cities of India. Really, it's a nice thing to do. But is it really creating a deep impact? No, that is really for the more privileged amongst us who use some of these facilities. It's a good facility, but not really. So infra plays, all of these spaces, we see very few. I think media has had investments from time to time, but if I really look at it, it's just an issue of what kind of funding you have. It's a little more risky. You have to take some chances. So, that is a sector I would think if I could urge some of the people to seriously consider. That would be a space, because really the poor in this country, there's a desperate need for low cost, decent quality healthcare. I think we should just move on to the larger discussion, perhaps.
We should, but we should get some prize to be 1 minute before time.
Yeah.
Okay.
We have cocktails in the evening.
Okay. So I think we're moving to Q&A. We should now.
So why don't we pass?
Perfect.
Yeah. Before that, we'll go around with a quick round of introduction with the name and the organization you're from, so that we'll keep it interactive as well.
Hi, I'm Rajiv Pahi, GP with Parinama Ventures, and we are sector agnostic in the ESG space, and starting off to build real big businesses in India. Thank you.
Hi, I'm Dheeraj from Rabo Foundation.
Everyone, Sucharita from the Aspen Network of Development Entrepreneurs.
Hi, everyone. I'm Vishnu Banerjee from the IPO Foundation.
Hi, I'm friends Karthik Desai from Desai and Associates.
Hi, Priya Tripathi from Bill and Melinda Gates Foundation. Hi, I'm Shruti Gupta, also from the Gates Foundation.
Hi, I'm Ritika from IP Global, working on the Samrid Blended Finance initiative that Himanshu spoke about.
IP Global Limited.
Hi, I'm Archana. I'm also from IP Global Limited, working on the Samrid facility.
Hi, I'm Aditi. I'm part of Vital Strategies, which is a global public health organization.
I am Priya Shah, GP of Theia Ventures. We're an early stage climate fund.
Hi everyone, my name is Dhruvi. I work at Capri Global, which is an NBFC across India, but we also do have a family office and looking at impact investing more and more going forward.
Hello, Neera from Vibriti Asset Management.
I am Varun from Ashika Group's family office.
I am Shabazz from Trust Investments, Merchant Banking.
I am Mandar Gupte from Raintree Family Office.
Atreya Pari from Raintree Family Office.
Hi everyone, Manu from JSW Ventures.
Hi everyone, I am Tarini. I am from the Radical Fund. We are an early stage VC fund, planet focused.
Hi, Luca Torre from Gawa Capital. We're an impact fund manager based in Europe.
Hi, I'm the third Priya in room from Habitat for Humanity.
Okay. No, I think very exciting, and I am very happy, pleased to see that so many folks in the impact, and thanks Neha for inviting to participate with this August gathering. I have three parts to my question. One, obviously the sector is opening up, and these are still early days. One is that in terms of we have the last mile connectivity, a lot of people putting in funds, a lot of people getting in at a stage where the business models are relatively more, I would say, stable, secure. And healthcare for one, obviously, Himanshu, and knowing Ashwajit, I know he would give you every piece to be going into every detail, so that's great. But the piece what kind of intrigues me is the fact that the technology, if we have got to really make impact with the technology, how many folks are willing to bet, that which are, I would say, successful technologies from overseas coming in, built frugally for India. What is the serious commitment, interest to get into those, because those may not have been, I would say, implemented here, but those could make a change to waste management, water management, energy, agri-tech, every space you talk about. So that's a kind of a technology impact acceleration is the way we look at. And the second is that what's the size of investments which family offices could look at, if that's one piece which I would like to have an open conversation. And third is that what is the kind of returns, because these would take anywhere between about 3 to 5 years. So though there are people who have put in the money, I think if that's where it is, it could create trillions of dollars in terms of building up the economy to a very different level. So that's my perspective, but would like to hear these three parts to it: the technology, the sizes of investment, and the kind of IRR what folks look at.
I've seen a lot of tech-enabled investments, right? Whether it's healthcare or education or agri, technology has been leveraged, right? Sometimes it could be in-house developed technology, or it could be looking at Indianization of technology which is available. That is done, right? I mean, digitalization is probably the base for everything, whether it's my fund or anyone. Everyone has digitalization as a basic given. I think a lot of things like government is doing, right? The UPI thing, or improvement of the logistics in terms of the Gagan Shakti program, what government is doing, or getting better roads and railways, that's been there. So tech enablement is taken. None of us on the panel would do investments if it's not tech enabled. I mean, maybe it's not tech developed, but it's tech enabled for sure. The second question you mentioned is about the size of the capital which a family office would do, right? It really depends on family offices, how they are looking. If they are looking to take moonshots, I mean, definitely it's going to require a larger pool of capital. But if you get excited about a particular theme or a particular kind of fund structure, maybe a couple of crores to begin with, because we also expect family offices to start dipping their toes in the water before they start jumping in. Look, we are always in the fundraising mode. So any amount you give, we will take it. But it's not the case. You really want this to be a long-term relationship, because the global family offices, whether it's Europe or US, they have understood the Indian markets way before the Indian families started exploring that. So their ticket sizes have gone to few $1 million. But I would believe the Indian family office could start with like 3 to 5 crore check to figure out whether that makes sense for it or not. In terms of IRR, I mean, please consider this to be part of one of your portfolio investments. You cannot expect, because everyone here is taking excessive risk to generate an impact. If we get it right, I think the IRRs would be fabulous. But the chances of us getting it right is not so great. So you need to be very cognizant, saying that if you have $100 to deploy, maybe deploy $5-7 into impact ecosystems, classify over 2 or 3 funds, and then figure out what to do. Any one of us could fail, any one of us could get successful, we could be very, very moonshot. So that's how I put it. It's more like a portfolio management. Treat this as one of your asset classes to deploy capital.
Thanks, Vignesh. Just like to add on, maybe I should have been more specific. Technology could mean not digitization or I would say AI and other stuff. For me, if I'll give you 2 examples which we have just showcased and building up. One is the soilless farming. With higher nutrition, 4 times the return, production payback in about 18 to 24 months. So again, not tested technology in India, soilless farming, which is one piece. It's a different technology. Second is cleaning a slush-filled lake within 48 to 72 hours to make it freshwater lake. Again, that's the kind of technology. So I'm just giving some contextual examples, not the digitization piece. So maybe that's something which is a different perspective, just to add on to what you're saying.
I think thanks for this. Right? Look, I think we do look at such technologies, right? I mean, whether it's enabling technologies, what you mentioned was soilless farming, it's definitely experimenting in the Indian context. Maybe it's not relevant for Indian markets. I mean, we think right now it's probably a rich man's hobby, soilless farming. It's not where I can take care of 130 million farming families. I have an issue. So when we look at impact, it's not always about getting the best IRR, but saying, can we get the best impact along with the reasonable profits? That's what we look. The slush thing, what you mentioned about the water lake cleaning, I think that's, a lot of people have started to do it with working with municipal organizations to get the solution, but I don't know whether it is scaled or not. Anyone else?
Not from the agri space, but to take the example from the healthcare space. So there have been cases that we have supported under our program where the technology came from outside. So this innovation, whether it was in diagnostics or whether it was in treatment, was done in the European market or the American market. But then the founder had the target that they want to reach the vulnerable populations in LMICs as well, be it in India or in Africa. And to bring down the cost, they were also willing to set up their plants in India for manufacturing. So those kind of solutions is something that we actively look at and support. To your other questions about the ticket size for family offices, and to what Dinesh also mentioned, I think family offices can take few bids at an early stage, and there are enough examples, successful examples that are emerging, again coming from the healthcare side. We have just supported MRI manufacturer, Indian homegrown MRI machine, to scale up their operations. And the early stage seed investment into that venture went from the Tatas. So as a family office, they had invested into it when it was at an idea level. Nobody, 5 years back, if you would talk that India will manufacture an MRI machine, nobody would have believed on that, because that's an area which is dominated by the large medtech companies. But those kind of things, innovations are happening, and family offices can take early stage bids, which requires a couple of crores only. Get onto the driving seat, help the entrepreneur, and help them move in the right direction.
Thanks, Himanshu.
Yeah, maybe I just wanted to just put a question in this context here, and maybe I'm the wrong person to be asking the question, but nevertheless, one model is the larger model of Dinesh, or for that matter, whatever media follows or others, which is really the sort of relatively higher return portfolio. The other end is maybe some companies don't make it, they crash and burn. What happens to the guy in the middle who's neither that top end, 30, 40x return, neither is he crashing and burning. But maybe he's going to grow 15, 20%, maybe, high teens, going to create decent impact. but may not be able to generate the very high returns that one is expected in a fund cycle of maybe 6, 7, 8 years. Because first couple of years, just deploying, figuring it out, and obviously by the time Dinesh should come to the 6th, 7th year, you are already waiting for the exit. Now maybe this company is not yet either at this end or at that end. Now, what is the scope that we have as an ecosystem for below market rate return capital? So which is what I'm saying. So is there a market for, say, someone who says, hey, you give me SBI fixed deposit rate, I'm happy. Or can I get an annuity kind of model, which is neither the crash and burn and neither the high return, sort of expectation that can be there from a regular fund. So I just wanted to just put this on the table, especially for family offices, to think about models which are hybrid somewhere in the middle, because I do think that over a period of time you are going to perhaps create these kind of companies. And my worry is with a very traditional VC model, if I'm a VC and I see that this is what this company is going to be, perhaps I will not channelize capital there because it doesn't meet what my expectations of return are. And therefore you're going to actually take the company in the other direction because he's going to be capital starved, because that is the model of funding that perhaps the organization has gone for. So I just wanted to just put this on the table in this larger context as to whether there is a scope for family offices to think about this in different ways, or even come into traditional VC structures, but maybe at a different sort of risk return level, which really enables you, if you're getting the gist of what I'm trying to say, Dinesh, is because there may be guys who will operate in this zone. So I just wanted to leave this. Yeah, please, but Sarvesh maybe.
To pitch in this question was, this is something that we have been doing, for a while. While most of our capital would end up going to companies, which we described as high impact and high returns, opportunistically, and I would say probably 1-2 deals every year, we would end up making in companies that we believe will be very catalytic from an impact perspective, but might not be able to deliver, market-based returns. But given the potential for impact, we will do it. Like you said, there are perhaps different principles when you make those investments, partly because of the fact that there is not enough follow-on capital that might be available for those companies. So the approach there slightly differs, where those companies also, the sensitization with them is how do you, for example, reach to profitability sooner, than might be required for some of the other companies, because you might not have this capital available after we come in. And so that's a constant dialogue we will have with those companies. But there is definitely a potential for more capital coming in some of these impact adjusted sort of returns from that perspective. And so what we look at it is what we call as the impact continuum, where on one hand we have high risk, high impact, high return companies. In the middle we have low returns but high impact, and then we have what we call as the not-for-profit, where it's only impact and there's no return. And then, as a fund, we look at, okay, how much capital do we want to deploy across this continuum?
So, what I was earlier referring to is exactly to solve this particular problem. That there are, let's say in education, right, a lot of companies which will do well, they will build a business, but it's not a VC. And what we've seen is with our entrepreneurs, then they're left with a choice, either to take a different path from what the original intent was, and therein lies the need to innovate by family offices and others to bring in a monetization line which is linked to impact. That could be game changing, right? So you are delivering returns, but the impact line right now is not showing in any of the financial statements. It's a call which is being made by the entrepreneur or of the boards. But if you can monetize that particular line, but there's one challenge over there is that the monitoring evaluation shouldn't take 40-50% of their money, right? So it should be digitized in a way where people actually understand. And if we can do that, that's a moonshot for the impact investing industry. The second thing, I wanted to go back to the tech question. Again, linking it up, like in the education sector, when some of the investments which GMC's made or Medear has made, the ecosystem also evolves, right? So if you really look at on the digital public infrastructure, there is a lot which is coming on the education and skilling side also, where you don't really need to build the tech, but the digital highway is there. The discovery of the provider and the seeker in a B2B sense can be done. And so, 1,000 flowers in terms of enterprise can bloom. Yeah, that way also, from a macro kind of situation and where India is going, there might be opportunities which might exist, but it will require entrepreneurs to get a path to build to that. And that's where using the DPIs and the education to skilling to employment, specifically, that's a sector which we look at, is going to be game changing. Not only for our Build in India businesses, but those could again expand into other markets, emerging markets, right? Because the belief is if it works with 20 plus languages, 60 boards, 50% of the population below 25 to 50 million children, then those models can be exported outside.
He just wants to respond on this one.
Very different view, right? Look, I think in a country of 1.4 billion people, if you're not able to scale, there's no point in running it. Capital is scarce in this country. Let's get the facts right. I don't want to put a capital which is going to create small, cute business impacting few thousand people. Country of 1.4 billion, 800 million people getting government-supported food every day. I think it's not fun. I would say if you can't scale up, close it. If the entrepreneur doesn't have it, boss there are other entrepreneurs. It's as simple as that. Keep it simple. For family office, decide what you want to do it. First you want to start creating moonshot, start understanding the impact space. You decide, right? I think everyone gradually grows up and decides how they're going to grow it, right? But what we have seen from our experience is that keep it simple. If you have too many objectives to be achieved, you achieve nothing. That's what limited point.
Yeah, kind of building on what you're saying, Dinesh, and sharing my observation as we work with and we invest in human and planetary health venture and growth stage. I think I echo what you're saying that European family offices are a bit ahead of Indian family offices, and I'm here to learn what Indian family offices are interested in. But what we're seeing is that we have removed impact from our own narrative. The simple reason being that these family offices care a lot about the market returns. And that's just the bottom line of it. It's our job as investors to become sector experts where you understand where the impact lies. And like you said, most of us said that the best opportunities where you align financial and impact returns. I think that's what Leapfrog does as well. So I find it difficult when we say family offices should accept below market returns because that's when they'll run away. And we're not going to create that long-term sort of scale in investing. But the question here was for the other family offices, and what you are observing is where is the Indian landscape at the moment? My hypothesis is that it's not so much in let's go impact first. That still is sitting in venture philanthropy. I'm totally with you on creating moonshots, but doing that in companies and tech where you can actually get to higher financial returns. So if there are any family offices that are investing here or your experiences raising here, I would love to hear how the Indian family offices are thinking.
Okay, we should definitely take it offline. This is prefer to invest in high return, but ultimately impact investing is across a spectrum. And we say that they're also more positioned to take risk, like what Medear has done, like what others have done. So just your thoughts on that, getting family offices to come in for debt, for blended finance with Himanshu's experience, and sort of the counter to that for us.
My question is very simple. Non-FS impact sectors, are we going to see a lot of IPOs in the soon?
My very short answer, yes. But can I take Karthik's question? Anyone else? No. One more?
Just one more question here. Should I ask now?
Yeah.
So, we're talking about impact investing, we're talking about high returns and high impact, right? I think high returns is easy to understand. We all have our metrics as funds to report high returns. Very, very, tangible, very, very direct way to understand high returns. I struggle to understand, how do we understand high impact? I know some of us in the room have done a remarkable job of explaining, in their reports about what kind of impact they're having. But what's a good way to legitimately report high impact? I think it's very important that we as funds should address that, right?
Okay, that's it.
That's it. Yeah.
Fundamental point is, what is the investment strategy of the family office? Let's not get confused about a number of things, right? In the sense, it may be, I don't care about anything, but I want to create returns. Then the allocation is different, right? Usually how it is done is, with the help of an expert and a professional, is these are buckets, right? So you have a moonshot bucket, you have an impact bucket, you have a climate bucket, and a large part of it is between traditional financing, where you understand historical returns. So I think as European Family Office and American Family Office have agreed, this evolves. What is happening is, I think by DNA, Indian family offices, because they're running, they're usually younger in terms of their evolution, they are also closer on the ground, right? You don't have fourth or fifth generation sitting away from. Therefore, they understand impact much more closer. So there seems that there could be some alignment of them trying to ride 2 or 3 horses at the same time, including, Ramraj, to your point, some guys who may be willing to take some sort of a blended return or trying to create a blended play. I'm in Jinesh's camp. I think there are profitable businesses or fundable businesses. And fundable businesses are a very different aspect. And I think if you apply capital structure to this, bad businesses will die and should die. So that is the other part. And the last part is impact measurement, someone asked, and I'm sure everyone can take it. I think all of us are trying to, there are best practices. There are certain DFIs who have created certain benchmarks. They're audited, they're getting verified. There are litigations now happening. If I've claimed something and you have relied upon that, there are climate litigations, there are social litigations, because you have relied on the outcome that I've addressed. Forget that, there are also subsidies that are available, that I may be availing because of that. So this is still evolving. We believe that as long as you follow certain standards which are led by IFC or GIN or PRI, a lot of these things will get audited and verified. Sorry.
To Karthik's question, I think based on our experience, what we have realized is that we have to distinguish between impact investing and philanthropy. Family offices also, they can have philanthropic arms of their own and invest their philanthropic capital. When it's impact investing, everybody is looking for returns. And that's going to be the case whether it's European family offices or the Indian family offices. So when we go out to raise capital, we should also be clear about that if you're talking to the investment arm of the family office, is typically going to be commercial returns that they're looking at. Otherwise, we should talk about the philanthropic arm. Like JSW Ventures is here, they have JSW Foundation, they have JSW Ventures. There's a clear line of distinction. And similarly, many of the family offices have. So we should be kind of aware of.
Thank you very much.